Hello everyone, this is Vishal Swal here, and today in this video we are going to talk about three stocks that will provide you big profits in future. And these are small penny stocks, and some of you have asked to do a fundamental analysis on these three stocks. So let's find out that you should invest in these stocks or not. So the first stock that I have chosen is Gravita India Limited. So the current share price for this company is around 107. So Gravita India Limited is a company that actually is one of the leading lead producers with annual capacity of 98,000 tons. So if we look at the key metrics and the returns of the company, then we will find out that the returns have been really great in the last year. The company has provided 140% of returns, and in last 3 months the company has provided 98.52% of returns. And also if we look at other factors in the key metrics, then we will see that the dividend yield is like 0.6%. that is a good number. And also the market capital for the company that the company has is 740 crores, which is really good. And the PE ratio is actually looks like the company is a little overvalued. And the PB ratio here, it still looks like a little overvalued because it's supposed to be less. So earning per share is 6.3 rupees. So let's go ahead. So the promoters is 72.51% for the company, which is like great. So let's look at the annual revenue report. So the total revenue has been increased since 2017, and the company has managed to grow continuously. And also the profit margin have increased. So the one thing that I really liked about this is that the earning per share for the company has increased from last year 2019, which makes it look more attractive to shareholders and investors. So let's do fundamental analysis of the company. So Gravita India Limited is incorporated in the year 1992. It's a small capital company and having a market capital of rupees 739 crore, operating in metals. So it tells that this company is old. So Gravita has a 13 recycling facility in Asia, Africa and Central America. Gravita India Limited key products in a revenue segment include lead, aluminium, plastics, etc. So for the quarter ended in December 2020, the company has reported a consolidated total income of rupees 372 crore, which is up like 7.16% from last quarter. So the company has reported net profit after tax 16.73 crores in last quarter. So the company has managed to make good profits in 2020, which is like really great. So Gravita India Limited is one of India's largest secondary lead metal producing company, and it practices a highest level of corporate governance as a key driver of sustainable corporate growth and long-term shareholder value creation. And company price to earning to growth ratio is 1.58, which looks attractive. So let's look at the chart of the company. So as we can see, the company is trading around rupees 107, and in future the company is supposed to grow to rupees 150 to 2000 in long term. So before you buy this company, please do your own analysis. So the second stock I'm going to discuss is Marksans Pharma Limited. So the current price for this company is 59.60 rupees. So Marksans Pharma Limited is a healthcare company. So let's look at the key metrics and returns of the company. So the company has increased its returns in last 1 year. The company has managed to grow 376%, which is a good news for investors. And also the market capital for this company is huge, like 2,439. And the PE ratio is 11.99, which makes the company looks overvalued a little. And the dividend yield is 0.78%, which is great. So the shareholders that we have in this company is around 48.25%. So let's take a look at the annual revenue report. So the company has managed to grow after 2018. So the one thing that I really like about the company is earning per share. It has increased from 2018. So that's great. That's good for shareholders. Maybe more people will invest in future in this company, which definitely increase the share price. So net profit margin has also increased from 3.92 to 10.64 since 2018. The company has provided growing profit, as we can see. So let's do fundamental analysis of this company. So company is a manufacturer of pharmaceutical, medical, chemical and botanical products, and the company was started in 1992 and has headquarters in Mumbai. So for the quarter ended in December 2020, the company has reported a consolidated total income of rupees 360 crore, which is up 23.4% from last year. So the company has reported net profit after tax 58.95 crore in last quarter. Company has a capital of rupees 2,419 crore, which makes the company look more attractive to shareholders. The PE ratio is 11.68, which might be lower as compared to the complete industry. So the company has 4 daughter companies, which makes it a parent company, and the Indian pharmaceutical market is among the top 5 emerging pharmaceutical markets in the world, which means the market and profits will increase in future. So let's look at the chart of this company. So as we can see, the company has grown since April 2020 from nearly 10 to 60 in last 1 year. So maybe if we look at the long term, the price will go up to rupees 80 to 120. So if you like this company, then you can do your own analysis. So the third stock we're gonna go into is Vertos Advertise. So the current share price for this company is 288. So someone asked me to do a fundamental analysis of this company, so I decided to analyze. So this company focus on growing digital businesses. So let's look at the key metrics and revenue growth. So the one thing that we can see is that the PE ratio, which is 106%, which means the company is really overvalued right now. So I don't know, it's good investment because the PE ratio is very high. It's supposed to be lower as compared to the sector, which is like 31.3%. So the company is really overvalued, and the book value per share is also 41.78, which is high. So the company provides small dividend yield 0.0%, which is less. The market capital is 344 crore. So let's take a look at the fundamental analysis of this company. So the company came in 2012, based in US, and now operating in 5 countries. It's India's first publicly listed ad tech company. So the company have businesses emerged swiftly and smartly in their digital expedition, and the company has increased sales by 11.2% as compared to last quarter, but sales have decreased as compared to last year. Company main focus is on sales, which makes it look attractive to shareholders, and company has a capital of 344 crore, which looks attractive and has a nearly zero debt. So the company has PE ratio 110, which makes the stock overvalued, and also earning per share has decreased drastically in the last few years. So if we look at the chart of this company, then this company has grown from rupees 80 to 288 in last 1 year. So this company is really overvalued right now. I don't suggest anyone to buy this company and invest in this company right now. So if you are holding the stock, then I think it's the perfect time to sell, and also do your own analysis. Thanks for watching this video.
22 million in 3 hours! I don't listen to the haters, man, I treat them like the enemy. Had a couple traitors, man, but now they know the penalty. I tell them, see you later, fam, I do not